Equities markets can be effectively analysed through a macroeconomic lens, with specific sectors serving as valuable proxies for various macro drivers. Understanding how different sectors respond to changes in economic conditions can guide traders in making strategic decisions and managing portfolio risk. Firstly, financial sector equities are strongly influenced by interest rate movements. Rising interest rates generally benefit financial institutions like banks and insurance companies, boosting their profitability through increased lending margins and investment yields. Conversely, falling rates tend to compress margins and negatively impact profitability. Traders monitor central bank policies and rate forecasts closely when evaluating financial stocks, using them as indicators of broader monetary policy sentiment. Industrials, meanwhile, serve as a reliable proxy for economic growth. When GDP growth accelerates, demand for industrial products such as heavy machinery, manufacturing equipment, and transportation infrastructure increases significantly. This sector's performance is often used to gauge overall economic health and growth prospects. Therefore, traders typically overweight industrials during periods of economic expansion and underweight them during slowdowns or recessions. Consumer staples are classic defensive stocks, performing relatively well regardless of broader economic fluctuations. Companies in this sector provide essential products like food, beverages, and household items, which maintain steady demand even during downturns. As a result, staples typically outperform in periods of economic uncertainty or recessions, acting as safe havens, as traders often increase exposure to staples during periods of economic uncertainty or market volatility to reduce portfolio risk. Technology equities are particularly sensitive to changes in liquidity, interest rates, and market sentiment towards risk. Often described as long-duration assets due to their valuations depending heavily on future growth expectations, tech stocks are highly sensitive to shifts in interest rates. Lower interest rates and ample liquidity typically support tech valuations by reducing discount rates and fueling risk appetite. However, rising rates and tighter liquidity conditions can significantly pressure tech valuations, prompting traders to adjust their exposure accordingly. By interpreting sector performances within a macroeconomic context, traders can better predict equity market trends. Monitoring key economic indicators, including central bank decisions, GDP growth, inflation trends, and market liquidity, helps traders strategically allocate across sectors, improving returns and effectively managing risk in various market environments.